Have you ever looked at your 401k statement and just thought, what the heck do I own? Or do you hear people talking about investments and you're like, I have no idea what you're all talking about? This video is going to break down different types of investments into 4 buckets. Our first bucket is going to be cash and cash equivalents. Now this is going to be the most liquid bucket that we're going to cover. It's also going to have the lowest amount of risk, and it's going to have the lowest return on investment simply because the risk is very low and also the liquidity is extremely high. Liquidity meaning you can convert whatever you have into cash. So what is in bucket number 1? You have the simplest and safest form of it, which is cash. Whether you're in the United States and you have dollars, you're in Europe and you have euros or pounds, if you're in Japan you have yen, this is going to be your safest investment, or just your cash. Next level up from there is going to be your checking savings account with a financial institution. Now this might pay a little bit of interest, probably a little bit more on the savings than a checking, but very, very safe. In the United States, your FDIC insured up to $250,000. So extremely safe investment. Next from there is a money market account, which is also FDIC insured. The risk is a little bit higher and usually get a little bit higher of an interest rate because of that extra risk. Next is certificates of deposit, also FDIC insured. The one thing with a certificate of deposit or a CD is you're locking up your money for a period of time, which means if you lock your money up for 6 months, you can't touch it. And if you do, there's a penalty if you withdraw from a CD earlier than when it matures. Usually with the certificate of deposit, the interest rate's going to be a little bit higher than a savings, a little bit higher than a money market account. It's not going to be anything over the top, but you are getting paid a little bit more for locking up the money in a certificate deposit with the bank. Okay, bucket number 2. This is going to be your fixed income. Now, with fixed income, liquidity is going to go down a little bit. Your return on investment is going to go up, and your risk profile is also going to go up. So as your risk goes up, your return on investment should go up as well, but your risk for loss is higher. So within this bucket, fixed income, you're going to have basically bonds, and preferred stock is another one I'm going to lump in here, which give or take could be in bucket 3 or bucket 2. But bonds can get sliced and diced into a lot of different types of bonds. You can have government bonds, you can have a state bond, you can have a federal bond, you could have U.S. Treasury. A lot of times with government bonds, you're going to get a tax advantage on the interest. Now, because of that tax advantage and you're working with a government institution, which is a less risky institution because you're backed by the government, that yield, or the interest you're going to earn on those bonds is going to be lower than, say, a corporate bond. So corporate bonds are going to be very similar. A corporation is going to offer a debt instrument to the public, and they're trying to raise cash either for a new business venture, they need to build a building, whatever the reason is. They're going to issue bonds at a certain interest rate, and you can buy those bonds, and basically you're going to give them the principal. They're going to pay you interest over the bond's life, and once that bond matures, they're going to pay you that principal back. Now, there's a little bit higher risk with a corporate bond because you have the risk of the company going out of business, but for the most part, corporate bonds, you look at the rating, you'll see AAA, AA, and you're going to have these rating agencies that will rate bonds. If you have a AAA bond, you can feel, if you have a AAA bond, you can feel pretty good and confident that that bond's going to get repaid. You're going to collect your interest. All right, equities. This is where you're going to hear like the Dow Jones is up, the NASDAQ is up. I can buy shares on the New York Stock Exchange. If you have any publicly traded company and you have a brokerage account, you can buy equities. So equities risk profile is going up. The liquidity is about the same as bonds. Is pretty equivalent. You need to be able to sell it on an open market. But the return on investment for an equity is much higher, but you also have a greater chance of losing money on an equity investment as well. What type of equities can you own? You can own common stock of a corporation outright. I can go to my TD Ameritrade account and I can buy Under Armour. I can buy Target. I can buy Walmart. I can buy Tesla. I can buy those shares on the open market. So what other type of equities are out there? You can have exchange traded funds. This is more of a passive strategy. Passive means you set the strategy and just let it kind of do its thing. And basically, exchange traded fund is going to own a bunch of stock. It's going to have usually a specific strategy where there's large cap growth. It's going to own a bunch of large cap growth stocks, and it's just going to do its thing. Mutual funds, on the other hand, they can have some passive activity with a mutual fund, but more than likely it's an active mutual fund, meaning it's actively managed. And basically an active manager is trying to achieve the greatest returns within the mutual fund. And mutual funds, again, are going to have a strategy just like exchange traded funds, but the manager might be like, all right, I need to get out of Google, I'm overweight, I want to put more money in Tesla. I'm not saying do that, I'm just saying that's what they're thinking, and they're looking at their portfolio and just trying to maximize the returns for the mutual fund shareholders. You could also have things like real estate investment trusts, REITs. REITs own underlying real estate, which is either going to be apartment complexes or commercial buildings, and they're collecting rent. And at the end of the day, their profits are then paid out as dividends that could be owned as just as easy as an equity, as a stock of Target. I can buy a stock of a REIT and collect the dividends along the way. What equities can do that fixed income and cash, the first two buckets, can do is equities can have a huge upside. I mean, if you you can buy a stock and you can get a 10 times return on it if you pick the right stock over a period of time. Like if you bought Microsoft in the early 90s, you bought Amazon in the early 2000s, you could really make a lot of money in equities. However, the flip side is you can lose a lot of money in equity. Currently in the market, where we're down like 30% right now, you could be down 30% in your portfolio, where a fixed income and cash investment isn't going to be down 30%. Maybe it's down 5, maybe 10. It's not down 30. So this is where the return on investment in the risk categories, as they get riskier, the return can go higher, but you also have the risk of losing more money. Bucket 4 is going to be alternatives. There could be a lot that's factored into this bucket. I'm just going to hone in on 2, which is private equity and commodities. Private equity is you have ownership in a private company. Either you've been invited to participate in a private company and own shares of it, which are not traded on an active market like publicly traded companies. This is where you need to know somebody to invest in that company. Or you can go to a private equity vehicle like a fund of funds managed by like a Carlyle or like a Silver Lake, where they're going to have direct access to these private companies, and you can invest in one of their funds instead of making that direct investment. Because typically with a direct investment, they're going to want a substantial amount of money, maybe like 100,000, 500,000. But if you get into a fund of funds, maybe you can invest with like 25, 50,000. It's going to be a high minimum regardless, but you can usually get in and get a little bit more exposure to private companies within your portfolio with a fund of funds instead of going direct. So commodities, this could be gold, this could be oil, natural gas, silver, a lot of raw materials out there. What you can do is you can go to a brokerage account and you can buy a oil fund. You could buy a natural gas fund. A lot of times there are going to be limited partnerships. We're going to get a K1. A K1 is just your ownership and your results of that fund for a year, and that ends up being filed on your tax return. Now with alternatives, private equity and commodities, these risk profiles are going to be much higher, so your return on investment also you're expecting to be much higher. However, your risk of loss is much higher as well. All right, let's bring that all together. So you get your 4 buckets: cash, fixed income, equities, alternatives. This is your basic portfolio or portfolio management. Now, I'm not going to go into great detail, but basically you want to look at your age and see where you are, because if you're young, you can take a lot more risk. You have a lot more time to ride out the waves of the volatility. So being in 100% equities or 80% equities and 20% alternatives, if you're young, that might not be a bad approach. On the flip side, if you are getting close to retirement, and you have a nice 401k, nice retirement account, you do not want to be heavily invested in alternatives. Probably don't want to be heavily invested in equities. You want to be more on the cash and fixed income side because you're going to need that money sooner, and you just cannot ride the waves of volatility of someone that is much younger. So that's just something to think about when you're looking at your buckets: cash, fixed income, equities, alternatives. If you're young, you can take a lot more risk. If you're older, you want to tailor your risk down. And just this, simplest way to get started with looking at these 4 buckets is get an Excel spreadsheet, get a Word document, whatever you're comfortable with, Google Sheets. Where do you have your cash? How much cash do you have? All right, fixed income. Is your 401k invested in fixed income? Do you own any other bonds and any other sort of investment accounts? Equities. Do you have mutual funds, exchange traded funds, stocks? Bucket that in your bucket 3. 4, if you have alternatives, commodities, or private equity, you can then bucket in that category. So you can look at your portfolio and say, okay, if I'm young, I don't want to have a ton of cash, probably minimal fixed income, heavy in equities, and then maybe a little bit in alternatives. If I'm 40, I probably want to be well diversified in all 4 categories. When you get older, you want to shift it all the way to the fixed income cash territory. Now, I'm not saying don't have any equities or alternatives. Just keep it as a smaller portion of your portfolio, maybe only with 20 or 30% in equities and alternatives, which will be bucket 3 and 4. And you want the majority of your portfolio in fixed income and cash. So you want to split the 70%, 50% fixed income, 20% cash. Hopefully that added up to 100%. All right, got some value out of this. Give me a thumbs up and consider subscribing to the channel. Hope you have a good rest of your day. Take care. Goodbye.